Okay, you can hear me okay. So we're kind of starting to run out of things to do in group therapy because, there's only so much you can say about trading before getting repetitive or before scaring the crap out of people that thinks it's so complicated. So I did say we're going to, get some people with real issues that we're going to start sorting out in the group therapy. But I did want to go over this first. And we did a webinar late last year about trend and chop, but I felt it didn't say enough for what we wanted to do, what I wanted to say, and I wanted to add some more. So it's two parts. The trading part is next week. We're going to cover a few other things today that I think you'll find interesting. But what I want you to do, I'm going to keep my eye on the chat. If you disagree with something I'm saying, raise your hand or say in the chat, and I'll try to keep my eye on it. I may move the chat over to the screen share. So if you're a bit shy, let me know in the chat. Because I want everybody to see what's being said. Sometimes I reply verbally to what's been written, and it must be a bit confusing. So keeping it simple, it's easy to say, right? It's easy to say, keep it simple. But, the next thing you ask is like, how much complexity is enough? So we're going to talk about keeping it simple. And we're going to start off looking at futures versus equities for day trading. And just consider that from a complexity point of view in terms of what influences those markets. Then we're going to look at how connected things are. And there's a complexity there too, in terms of understanding, how all these markets fit together and trying to get to the point where which was the tail and which was the dog, or which market was in charge, or what happened first, that kind of thing. Then we're going to look at game theory, not because it's really about complexity, but it might stop you getting ripped off by bad vendors. But there's some really interesting things that happened with GME. Then we look at algos and HFT and how this complexity picture affects that and your perception of what they do. And then we're going to destroy a bunch of market analysis techniques. Not so much because I'm a superhero or I know a lot, but just because I want to give you the opportunity to kind of think again about some of the stuff that you might be using right now. And we'll get to that in a second. So the plan is we all leave with a headache today because if you realize how complicated this all is, you might not try and understand it all. So I think a lot of traders are suffering from a complexity in their approach that's built up over time. And some of it's the complexity of the markets. Some of that is the complexity of their own decision-making framework. So first we'll look at this market complexity. And the aim is to tell you that it is so complex that your brain will explode if you attempt to understand exactly what caused what. And with all that complexity, though, it can still only go up and down, which is actually simple. So before we look at the complexity, let's just bear a couple of things in mind. First of all, it is possible to make money in the markets. And second of all, it is possible to do so without knowing that the order that finally pushed the market through a range was some guy exiting a hedge trade used to offset an option they'd written, right? You don't need to know that stuff. It's there, it's information, but you don't need to know it, right? And it's very difficult to find out what the trigger was. So if something is too complex to really know, we shouldn't look at trying to know it all for the answers, right? So the answers are there, but they're not in understanding everything. If you've ever read the book, Trading and Exchanges, I don't know if it's like 500 pages of just information about the markets and the structure. And it's like, it's interesting, but it's not really going to give you an edge. Now, the reason we look at equities versus stocks is just to show you that the complexity does vary between types of markets. So I like futures and stocks. I think they're both good markets to trade, but I started out in stocks and I left. I quit. I knew I was beat. Now, if you want to trade stocks, there are some skills that some people have that help trading stocks, but it's really more long-term than anything. So if you've been at a high level in the corporate world and you know your way around company accounts, there is a lot of merit of using that skill to trade stocks. And I'm not just talking about book skills or being an accountant, because the accountants aren't the people who kind of make those big decisions. So it's really about the game that's played with the books in equity markets. Stuff that's legal, but questionable, and some stuff that is just plain silly. So, I've seen it when a company gets told you need to make a 10% cut in all budgets. And to make the 10% cut in the salary budget, they let employees go. They pay them a severance, and then they hire them back as contractors at a higher rate. So the result is the payroll budget did indeed get cut by 10%. And the contractor budget that they weren't using got used, right? So costs went up to comply with the command to cut costs. And it's just madness, right? I mean, it's silly. There's other stuff, like sometimes money gets spent unnecessarily on stuff because an unused budget doesn't get renewed next year if you don't spend it. So you've got a set amount of money to spend each year. If you don't spend it, then at the end of the year, you need to spend it or you won't get it next year. Now, why you need it next year if you didn't spend it this year, I don't actually know, right? Now, has anybody here been at a high level in a corporation? Like working with C-level execs and working around the end of quarters, end of years? Okay, cool. So Joshua, you can back me up on this if it's right or wrong. So if you're at high level in one of these organizations, you know that every time you want to sneeze, burp, or fart, it has to go through the COO or CFO and the corporate counsel, their lawyer. And they're going to insist that every time you want to do something, you've got to follow every rule that exists to the very letter, right? And we call it the sales prevention department. Now, that happens like through the year, but at the end of each quarter and the end of each year, these same people that are sticklers for rules, they all turn into Coco the Clown as they start shifting numbers around, pulling things in, pushing stuff out, and playing all sorts of games to make things look better or worse as appropriate, right? Now, if you've experienced this, you'll know it's usually done to influence a specific set of numbers, right? It does comply with the rules. I mean, I've been asked to do stuff that really was, that would have got me sent me to jail if we'd been caught, and I just refused to do it. But you can basically influence one set of numbers, but you can't influence all the numbers. So people that have been in this corporate world can't do this in one quarter, but basically if you look at the balance sheet, the cash flow and the P&L, those kind of shifts around, if it's done consistently, does stand out a mile. And that is something you can use, right? So Joshua, did you experience that, shifting stuff around? Or you're very clean? Yeah, all the time, yeah. So basically between the P&L, the cash flow and the balance sheet over time, you can see when something's been pumped up or otherwise. But things like, if you've made a loss, you might as well make as big a loss as possible by, bringing forward losses, potential losses from next quarter, that kind of thing. In my opinion, that's an edge. But I also think that stocks intraday are a lot of work. So I've met a trader. He was trading a $30 million account, and my friend worked for him as a researcher. And he was doing what a lot of equities traders do, which is try to figure out what's in play for the day and then trade it. And it's a great concept. The difficulty is that when let's say you get 20 stocks that are in play, by the time the market opens, 10 of them have already moved and maybe 5 of them aren't going to do anything. And then it's this constant search for opportunities. And that's the equities market. But the guy I met had 4 full-time researchers doing that for him. Other guys in prop firms also have researchers that at the start of the day will tell them what's going on. So that's kind of one of the big factors that had me leaving equities. If you look at futures, the things that impact futures, it's not the same kind of things. So with stocks, you've got earnings announcements, upgrades and downgrades, product recalls, new target prices, insider buying, all this kind of thing that people look at to decide if that's a good opportunity. With futures, it's really macroeconomic news. So the thing that impacts futures the most is big news, big lumpy news. And it's big news that's usually quite obvious, right? And I think really if you take away the difference between the markets themselves, the things that influence the markets are way less complex in futures because it's world events. If you look at stocks, I know there's 17,000, 20,000 of them. And you've got to figure out which ones are in play. So which one's got an earnings announcement, which one's got this. And it's just a constant battle. And I just found it just tiring, very tiring. Now, the other thing about stocks, fairly low leverage, usually 1 to 4 intraday, 1 to 2 overnight for retailers. You need $25,000. Now, I never understood this because stocks are less risky. You could trade 10 shares if you want, right? and you're not really risking anything if you just trade 10 shares, but you're kind of forced away from that and forced towards futures, which has much higher risk. And you're forced into that direction because of this $25,000 pattern day trading rule. And the reason that is the way it is because it's just different organizations that make up the rules, right? So, the equities market pushes traders with lower capital towards futures, which has higher risk. The stock market is always quite fragmented. So there's lots of exchanges trading the same stocks. Then you've got the buying order flow, which created the dark pools. So I know I spoke to a trader and he explained something to me. They would go fishing in dark pools. They would just put out little orders in dark pools and see if they got filled to see where the liquidity was, and then they'd make a play. And to me, again, it just seems very, very difficult, doing all stuff like that. I'm like, wow, that seems like a lot of hard work. They are influenced by these kind of bigger picture news of stocks, but you've got all the company news and events that influence the stock as well. And usually it's different stocks every day, certainly at earnings season. So you end up spending a lot of time creating watch lists before they're open, and then you see a lot of them do nothing. Then you use a scanner to try and find things that started moving intraday, to pick up movers. But again, if you use a scanner, it's going to tell you about the move when it's underway because it can't see it otherwise. And so you often get there a little bit too late. Then there's the selling order flow from, to HFT firms. But the fees are low, right? The fees are zero now. And there's limited hours. So equities, I do think it's a good market. I think it's a fair market. But I think all these little things that you see in the equities market, it just adds up to, it's really complicated to know what's in play and have a good watch list for the day and trade it. And then you've got the dark pools where stuff's going on, the HFTs. And to me, it's just tiring, to go all through that stuff. Now, on the other hand, futures have got high leverage, but it's not really that you've got high leverage. I mean, if you look at what most people do, if you look at the S&P at 3,000, the S&P 500 futures at 3,000, that is $150,000 a contract, and you can trade that $150,000 if you got $1,000 or a couple of $1,000 in your account. I'm not sure what the margin is now, but you're not really. I mean, in theory, that's 150 times leverage, right? But nobody's risking 150,000. So I think when people use these nominal values, like the full contract value, the numbers just become pointless. If you ever heard somebody talk about the amount, the value of the Forex market each day, it's based on these nominal values. It's based on doing something like, if you trade one ES contract, you traded $150,000, right? So it is more highly leveraged, but nobody's really using that leverage. So it all becomes a bit meaningless. There is no finite supply. You've just seen what happened with GameStop, where they started buying in the face of, a lot of shorting. It was 150% short. I didn't know it was possible. And there was a lot of buying. And the reason that causes like that kind of short squeeze is because there is only so many shares in the stock market. And that is an edge potentially and a benefit. With futures markets, there is no limit. So contracts get created and destroyed as you trade. So a new contract is created if you buy from somebody. It's, there is no supply issue. We've got one exchange per product. So we don't get the same kind of fragmentation you see on NASDAQ with all those exchanges. And I believe it's more consistent behavior intraday, right? You can get to know an instrument in the futures. You can get to know an instrument in stocks, but whether there's going to be any action in it every day is a different matter, right? So you can actually stick with a handful of stocks, get to know the macro news, which is very easy to do. It's much less work to understand the drivers for crude, even S&P, than 20,000 stocks and pick a stock, right? But with our markets, the exchanges do tend to really squeeze us. I mean, does anybody feel squeezed by the exchanges with the fees going up all the time? It is a bit of a squeeze. And we can trade 24/5. Now, there is a level of complexity because many futures contracts just represent one commodity. If you trade crude or corn or wheat, that contract is one commodity, right? When you trade the S&P, that contract is 500 equities, the underlying. So if you just look at the equities picture and the futures picture, you're going to have less complexity trading futures than equities, without any doubt. There's just less things influencing them. There's less exchanges. You can trade after hours, which is a benefit for people who work. And to me, it's a lot simpler, and it's really worth thinking about that if you're trading equities, that whether you want to handle that complexity, overcome that complexity to get your edge, or whether you just want to, it's not lazy to trade futures. It's just, it is a less complex market. Now, does anybody know what an index is? I know we've got the S&P 500 as an index. I'll just go over it. So an index is not something you can trade, right? An index is just like, it's almost like, what do we call it? It's an instrument, but you can't trade it. So the S&P 500 index is not something you can trade. It is just a calculation made by Dow Jones. Is it Dow Jones? No, it's not Dow Jones. It's Standard & Poor's, right? So Standard & Poor's, they calculate the value of the S&P 500. So they have like some algorithms, some weighting, and the actual index itself is not something you can trade, right? It's just like it's just some kind of indicator that's tells us where the S&P 500 is. Now, so the futures for the Dow, the S&P 500, and the NASDAQ, right? Those are futures markets that you can trade, and the underlying instrument, or the underlying, is the S&P 500 index, right? And a bit like crude, you trade a crude futures market, the underlying is crude oil, right? So if we look at the markets most of you are trading, we've got the Dow Jones Industrial, which is 30 massive, monolithic, old companies that probably aren't going to grow that much ever again. And then you've got S&P 500, which contains all the stocks in the Dow Jones, and that's the biggest 500 large cap stock. So that's what we're effectively trading. And then you've got the NASDAQ 100, which is large cap stocks. It's no NYSE stocks and no financial stocks, right? Now, the interesting thing, if you think about this, the Dow, the YM, is the monolithic no growth stocks, but it's also very volatile. And it almost doesn't make sense that the Dow futures is so volatile, but it's really down to how the instrument is structured, and that forces that. We won't go over that today, but we will look at it at some point. So when we trade the ES, we've got the underlying indexes, which is just something that a company maintains and lets people use. And then we've got the futures on top of that. And we've also got these ETFs. Do you all know what the ETFs are? Okay, we've got one that's called the SPDR, the SPY. So the SPDR is basically a one-for-one stock ETF that you can trade on the stock market that lets you get involved with the S&P. So it goes up and down with the S&P, and the people that run that ETF have to balance it and do all kinds of clever stuff to keep it in line with the market, right? So you've got that, which is connected to the S&P. But you've also got a bunch of things called inverse ETFs. So there's a list there of inverse ETFs. There's even 3x inverse ETFs. So which basically means if the S&P goes up, the 3x ETF goes down, right? But by 3 times as much. Okay. Now they're all related, right? Something can't happen in the S&P 500 futures without the inverse happening in those ETFs. So there's lots and lots of ETFs for S&P. There's lots and lots of ETFs for NASDAQ. There's lots of ETFs for Dow, right? And there's also daily ETFs, leveraged ETFs. If you're hearing about leveraged ETFs and daily ETFs for the first time, my recommendation is that you should stay away from them, right? Because they can go to zero. I've seen ETFs, LNGA, I think was an oil ETF that went to zero. There is more risk than just 3 times the S&P. So if you're hearing about these and you suddenly thought, well, I'll have a look at that, might just be able to trade some 3x S&P instead of trading ES, I would avoid it like the plague, right? I don't want you coming to me and saying, Pete, you told me about that ETF and I've lost all my money, right? But it gets a little bit more complicated than that. Okay, and I think I've covered most of it. So if you trade the S&P futures, you are trading the most complicated market on planet Earth because it is intertwined with so many other instruments that you can trade, and it's all held together or kept in line by arbitrage. Okay, so arb traders will step in when they believe the markets have gone out of line, and they will trade that disparity because they know it should come back in line. And in fact, it's their trades that make it come back in line, which is a bit of a brain teaser. Now, we trade the front month on the S&P, but we know there are other months, right? Does anybody know why the price of this quarter's S&P would be different from next quarter's? Bum, 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 bum. Term structure, I'm not sure what you mean. Mostly it's stuff like interest rates. Yeah, because if you can buy S&P futures this quarter or S&P futures next quarter, you should be paying interest on that. You're going to have to take into account the interest rates. And if you look at crude, the costs are different because of storage costs, right? Because you have to, otherwise you'd be able to get away with not storing oil by just buying the futures. And so those are things some of the things that are taken into account. But if the disparity between the price of things like two contracts in crude gets out of whack, which means more than can be explained by the storage costs and the interest rates and all the other things that must be really complicated to calculate, arbitrage traders step in. And that, if you just think about that, it's a very complicated thing to figure out if they're out of whack, and it has to be done very quickly. So it's really all algorithmic now. So we got the different expiry dates, and depending on the market, there may be more things considered in terms of the difference between the expiries. Like with crude, there's storage costs. With S&P 500, you don't have anything to store, so there's no storage costs. And the futures market, certainly S&P, has futures options. Anybody trade futures options? Okay, yeah, you do, good. So there's futures options. So, you've got different expiry dates, and then you've got the futures options, which are related to the S&P. Somebody's asking if the only driving factor is the interest rates. No, I don't study that kind of stuff. It's just one of the things. Just want to give you an interest, just wanted to give you an example. Then you've got the ETFs that we just looked at, and those ETFs also have options markets. And then you've got all the stocks in the index, and each of those stocks has an options market. And then you've got things like currency prices, which impact the revenues of multinational companies as currencies change. So that impacts the price of the stocks. Then you've got interest rates impacting the cost of the debt of those companies. And you've got relationships to other indices. So Dow is related to S&P 500. S&P 500 contains Dow, right? And it's arbitrage that keeps all that stuff together. So when I look at that, I think, wow, that's a lot of stuff, a lot of complexity, a lot of things that need to all move at the same time. And it's a lot of things to pull. Yeah, that's actually a good comment, Calvin. There's the micros as well. The micros are related to the micro S&P is related to the S&P, and the micros have options, right? So these markets are connected, and effectively you can't move one of those markets much without pulling the others with it. So that's a really important thing to remember, because to move a market to any extent, just to say, right, I'm going to come in, I'm going to push that around, it is a lot of heavy lifting, because it means moving a lot more than just that one instrument. Because the moment you just move the S&P, it's going to create a disparity. An arbitrage trade is going to step in and to take advantage of that disparity, and it's going to close, right? So do you get that with all these connections, you can't just pull one market? Yeah, CFDs again. Yeah, okay. Yeah, all right. Thanks, Mark. There'll be a recording. Mark's got to leave. So it is being recorded. So basically, do you understand that to move the S&P, you have to move everything else as well? Because the arb traders won't let you move the S&P out of line. Does that make sense? Right, now, the other question is, do you believe it? Mark says it makes sense and that he believes it. So it's a really important thing, right? Because it affects the things that you believe about the markets, right? You certainly cannot understand all this stuff, right? You can't use all of these different things as data points to make trading decisions. It's crazy. It would be too much, right? I don't know anybody that does it. I don't know anybody that claims to understand truly what caused an unexplained shift. It's just too complicated. It's just too complicated, in my opinion, for anyone to understand, right? Doesn't mean you can't trade it, right? Does mean that the arbitrage trade holds it all together, which means that for us, looking at order flow, not all order flow is directional, right? So there's going to be a lot of order flow that is arbitrage, right? As one market moves and the others get kept in line. There's going to be spread trading between the different expiry dates. And it would be kind of crazy to suggest that with all these relationships in play and all this arbitrage trade, it would be silly to suggest that you can make any assumption about any specific trade, right? So if you see a print of a certain size on the S&P 500, can you really make any assumption about it? Can you say that's somebody getting in? Can you say that's an algo? I mean, really, do you think we can do that? Can we say that? Give me some feedback, people. Okay, and I say that because you know what? People are making that claim, right? We know who is making that claim. So the idea that you can make any assumption about a specific trade or even a series of trades is absolute nonsense. Right? There are too many trades coming in that are not directional, right? So basically, it's better to not get caught up in all of that stuff. And when you look at this complexity, you can look at it as a negative or a positive. If you look at it as a positive, it means it helps you filter out a lot of stuff. You know, so claims that are made in the face of the fact that certain things are unknowable are bogus, right? And you know, there's also other things that are impossible. So you know, we can look at claims and say, you know, really, do they know that at that point in time? Can we really know that? You know, we can make some presumptions, right? You know, we know the markets are going to stay in line, and it's not by accident. We can't presume all the order flow is directional, but we can presume that knowing that will help us filter out a lot of BS, right? It'll also help us to be comfortable being wrong, because we're going to have to take some shortcuts, right? If the markets are really that complicated, we're going to have to make some assumptions, right? We're going to have to shortcut it because we can't know everything. Would you agree with that, guys? Yeah, I mean, when it's overnight, I mean, what you can assume when it's overnight, you can assume that the stock market's closed. And so the complexity overnight is far less, absolutely. And there is a bit more manipulation overnight too. Now, the other thing this should help with, it should help you select markets, right? So if you want to go with a less complex market, you know that crude is less complex than the indices. You don't have, it's still complex, right? You have the currencies, you have interest rates, you have storage costs, you have all these kind of things. But basically, crude is far less complex a market to understand than the S&P, right? But it doesn't mean the S&P can't be traded. It doesn't mean there's no benefits. But if the complexity worries you, you know, trade corn. You know, it's weather. It's, you know, it's a much less complex market. So if you understand that it's so complex, if you understand that you need to make some heuristic shortcuts, you need to make some presumptions, you should also understand that it's not possible to be right all the time, right? You've got to have to be wrong, because at the end of the day, flow can come in against you because something changed somewhere, and it's not possible to know all these things in advance. And you know, if you think about how complicated it is, it's much easier to say, you know what, I'm just going to be wrong sometime, and I'm just going to have to live with that, instead of trying to, you know, claw stuff back if you lose, and beating yourself up if you lose. And of course, this is going to sound like we're making it more complex, but really, what we're doing here is avoiding going down certain roads that claim to be able to explain everything, rather than actually saying, right, I'm just going to make some simpler decisions that aren't based on some sort of universal knowledge of the market. So just stay with me here, because this is going to make sense. And of course, this complexity is going to impact some common beliefs. The main one right now, God, this just annoys me, is about the algos, right? You hear it all the time, right? And you hear that specifically algorithms are intentionally moving the market from one point to the other. So how many times have you heard somebody say the algos are moving them, you know, the algos are moving the S&P to 3950 or something like that? How many times you've heard that? right? So I'll tell you two things. First of all, how would you know? How would you know that? Do you work for the firm that's doing it? And the second thing is, if we say in this case, we've got 1054 contracts there. So there's 1054 contracts. So if we said the algos are taking it to 901.75, right? We've got 1,054 contracts between here and there. And if an algo wanted to move the market to that price, they would need to buy more than 1,054 contracts. They would need to overcome any selling that plan to come in anyway, right, at those prices. They would need to overcome the arbitrage traders that spotted the disparity they created. And that means pulling all of those other markets with it, right? So you can't just move the S&P futures, you have to move everything else. And that's a lot of heavy lifting. And then the other thing is, what would the point be? So let's say you did buy a ton of contracts and overcome the arb traders and get the S&P to 3901.75 at a big cost. What's the point? Can anybody tell me what the point would be of moving the algo, of moving the market like that? Because everybody says it, right? But why would somebody do it? Because for me, if you'd bought that many contracts and overcome all that stuff and got the market to move, what's going to happen when you sell? It's going to go down again, right? It'll go down again. So to me, when I think about stuff like this, I think, first of all, it's a hell of a lot of work. It's a lot of buying. Second of all, you've got to get out, right? You've got to get out. Now, I do understand the concept of stop runs and stuff like that, but that's not what people are talking about. People are talking about regular moves being caused by algos, and the market will be market will be going up, and they'll pick a number 5 points up and say the market is going to 39.05. And when it gets to 39.05, they'll say, told you. And it's like, well, it was going up. It's only 5 points. It's pretty volatile now. It doesn't really mean anything because it goes 39.05 and carries on, So what you've got to do is, I really would like to see people get out of that habit, right? Because it bugs me to hear people say it, primarily because it's basically unfounded knowledge that people share as fact, right? And they don't understand how that's going to impact a new trader, right? So, given what we discussed so far, do you think it's reasonable that every day there's algorithms coming in to push the S&P 10, 15 points, and to do that? Is that something? Do you think all the moves are created by algorithms? I mean, I can get it that at a quiet time that you could push through some stops, but come on, man, it's just too much money, and it's like, where's the payoff, right? And I get there are other things at play, right? There is end of month window dressing. There is, there can be some certain option strike prices that somebody doesn't want to move. You can push through stops, but it seems that every move in the market is now explained by the algos, and I just don't get it, right? And and I can see this comment here. I just saw this yesterday. It's like somebody, I read this on a Facebook group that I liked, and then I left when I read this. It's something very important. There are daily 4 and 8 EMAs. There was a chart there, and it says price retraces back to the 4 and 8 constantly. Computers are programmed to buy and sell on these retracements. And it's like, which computers and which firm? And you just made that up, right? You just made that up, right? But people say that, and I don't know why they say it. Because they don't know. First of all, they don't know. And then there's no benefit to anybody, and there's no benefit to themselves. But people believe it. And I think some people believe it themselves, but it's not very helpful, right? It really isn't very helpful. And I don't think it's feasible anyway. So I've got to say, it annoys me. And if you've called me, sometimes I'll be on a call and somebody will say as part of a sentence, yeah, and the algos took me out. And they will know immediately that I'm not happy. And I try, my heart race, my heart starts racing, but I try and stay calm. And I say, what was that? They say something like, yeah, I got in, but the algos keep taking me out. What was that? And then we have to go through this thing of why they believe that and what evidence they have to keep saying it. And then 2 minutes later, they'll say it again. I'm like, okay, what was that? And it must really annoy them, because every time they say it, I stop the conversation. I go, you did it again, until they get really either annoyed with me or they give up, right? And I honestly believe this holds people's back. I really do. whether it's market moving algos or some other unfounded piece of groupthink. Fact is that people repeating unfounded facts that they don't research, don't know. Some of that held me back at the start, right? People just saying stuff worked without trying it, you know. And I think part of it is that people, they're trying to do something that they are not successful with, and I think it helps them. I think it helps them stroke their own egos a little bit by, you know, saying this stuff to people. And when there's a little group, a group that agrees, I think they all kind of, you know, feel good and pat themselves on the back. But to me, it's a bit like the flat Earth theory, right? And I don't know how that started. I think possibly it was a joke. I mean, you know, Dogecoin started as a joke and now it's worth billions. And now look at where it's gone, the Flat Earth Society. I watched a documentary on the Flat Earth people, and I was astounded. I was absolutely astounded at how complicated and how much evidence they had that the Earth was flat. I mean, it was all bogus, right? But it was like really well explained and really well done. And I thought, wow, that is a lot of work. Somebody's put a lot of effort into that. And when they started, I'm not sure why they believed it was flat. I'm not sure why they did that, but there is some desire in people to sound authoritative in areas where they're not. And that flat Earth, I mean, we can filter out flat Earth easy enough, right? But some of the stuff like the algos are doing this, it sounds really clever, right? And newbies hearing it for the same time, believe it and agree with it and pick it up, and then they're repeating it later on. And I think that influences the way people you know, get along their path in trading. And I think it slows them down, right? So I think we need to pass things through some kind of BS filter, because people do seem to want to conform. And when these things take off, people do want to teach newer people these facts that they know, even though they're not facts. They've never been proven. They're just stuff that the bloke down the pub said or some guy on the internet. It's just strange. I mean, don't you think it's fascinating that this goes on? I don't know what it is, but I'm fascinated by it. So I can't get the benefit of moving a market and algorithm doing it because you've got to get out. It seems like a lot of risk for not much reward. So that also means this whole beat the algo thing, or you're going to beat the algos and that's also BS, right? And it needs to be put to one side. You know, it's mostly arbitrage trade, right? And then people assigning cause to something that happened when they don't really know, because it is so complicated, you can't know. And people like it because people are strange and they act in ways that are quite counterintuitive, which brings us to game theory, which actually makes people look like a-holes, some of this behavior. But that's because it's the only explanation you've got sometimes when you don't understand game theory. Game theory does explain why they aren't actually a-holes, but did what you'd probably do in their shoes, right? So there's a lot of behavior out there that can be explained, but seems really weird. And a lot of that is explained by game theory. Some of the stuff that's going on with GME right now, there's so many lessons that's going to give us as it unfolds. And this one amused me no end and got me thinking about game theory. This idea that a bunch of people on the internet are telling a bunch of other people on the internet to put their limit sell orders on their long GME positions at $1,000, right? So somebody comes up with the idea and everybody follows. And that is just mind-blowing to me. Now, game theory itself, some of this stuff we're going to talk about, it's really not strictly game theory. But if you study game theory, you'll kind of be able to, you know, look at the behaviors in a slightly different way. So, you know, you've got these different sides in the GME fiasco. You've got Citadel, you've got the hedge funds, you've got the traders themselves, the retail traders. They've all got their own perspectives, and they've all got a natural desire to look after themselves and those around them. So, you know, you guys want to make money for your families, right? And that is kind of your priority, and everybody's like that. So everybody thinks they're right, and everybody thinks they're doing the right thing. Like I say, game theory doesn't apply to all of this, but we'll try and point out where it does. If you follow the strict definition, there's some things that are going on right now that it shouldn't really apply to, but it does help you understand how people reacted. And you would think that people's reactions would be quite predictable. And so when people look at the market and technical analysis, they are using a very simple cause and effect model that is based on everybody else making quite simple decisions, right? It gets to a point, you buy. Okay, but that doesn't take into account the fact that people are strange and they're still predictable, but the prediction is usually different from a very straightforward one, which is why game theory is so riveting. And I'll give you what I think is the best source to learn this shortly. And the videos that I'll show you basically revolve around a series of experiments that have been repeated many times and where the results seem really strange initially, but game theory explains them. And these games revolve around how people make decisions when there are multiple players, the outcome doesn't depend on any single player, and there's some sort of reward, usually financial, or any situation where two or more participants are involved, everyone knows the rules, and everybody's rational, okay? And that's a bit like trading, right? We're all involved in the market. We all know the rules. Not sure we're all rational, right? But it's a bit like trading. Another example would be companies competing against one another, where each company's actions influence the decisions of the others. So everybody wants to win, and their decision-making framework isn't just based on what they are going to do. It's based on what they think others will do, and that's where it gets a bit odd. And that's GameStop. And in GameStop, there's a few different games being played. So you've got one game, which is basically the retailers beating the big bad hedge funds, which you have to admit is a really good underdog story. But as it plays out, we'll see that this story has got more layers than an onion, or maybe a better way to put it, there's many games in play at the same time. Like one of the games was Robinhood gain a lot of their revenue from Citadel. They let people trade for free, and Citadel pay them to execute the trades, and they get a little bit of an edge off that. So the Robinhood traders put a major squeeze on a hedge fund that Citadel owned, right? And so Citadel's Robinhood's biggest source of revenue, and Robinhood traders are putting the squeeze on Citadel. And the eventual reaction at Robinhood was they suspended buying of GameStop shares, and they closed out a lot of long positions, right? Now that is not a good idea, whichever way you slice it. It's like a no-win situation for Robinhood and Citadel. Right now, I've got to say this, I am not saying that Citadel asked Robinhood to suspend trading. They might have done, but I'm making a point. I'm not looking for a lawsuit, right? But if you think of the outcomes, right? If Robinhood refused Citadel, said, no, we're not going to suspend trading. We're not going to close positions out. Citadel could walk away, right? But that's going to hurt Robinhood, but it's going to hurt Citadel just as much, right? Citadel walk away, they don't get that order flow anymore, and they profit from that order flow. So if Citadel walks away, they both lose, right? So if Robinhood doesn't suspend trading and Citadel walks away, they both lose. If they do suspend trading, which they did, Robinhood could lose a lot of traders, which is the same outcome. Less order flow, both companies lose revenue. So it's another lose-lose. So how would they, just suppose the Citadel made this request to Robinhood, how would they make that decision? There's some factor X, right, that helped them make the decision to suspend trading. Now, I can think of a few things that would lead me to make that same decision to suspend trading. So first thing, can you legally get away with it? I'm not saying is it legal or not, that's different, but can you get away with it? So that would be one factor. Another factor might be incentives that Citadel offer to Robinhood to do it. So that would sway the decision. But the other one, and the biggest one, and I think probably likely the reason that if Citadel did ask Robinhood, that they would have made the decision, how big is the risk that a significant proportion of Robinhood traders would move to another broker and trading platform? How big is that risk, really? Do you think it's big? I mean, you've changed brokers, right? So you can think, well, they could all move, but like, really, will they? Or can we give them a half-baked excuse about risk and potentially going out of business to allow those traders to convince themselves not to go through the tiresome process of moving? And I would say, if you look at this, and you're kind of damned if you do suspend and damned if you don't. And then you say, you know what? They're probably not going to move anyway because they're lazy. I think that would swing it for me. I'm not saying I agree from a moral perspective. Maybe none of this happened. None of it was considered. Maybe it's just a blind panic, a knee-jerk reaction. But if you throw in that last consideration of moving accounts being a painful process, I'd say that inertia wins. Right? I know traders, right? I know they're lazy. I know they really don't like moving accounts. So I'm not saying it was the right thing to do, that it was moral. Just you can see how it could be the best choice in a situation where the decision maker's primary concern is their own future income. right? Which is why we have laws, right? Because it'd really be cowboy time. Otherwise, people would make decisions purely based on money and we'd have a really bad society. But what about other financial decisions involving two or more parties, right? Like this one. This made me laugh even more. It's a push to say game theory would explain this because I'm not even sure what the game is, but I suspect it's keeping the status quo for the financial industry, right? And I just laughed out loud when I read this. Janet Yellen got $810,000 in speaking payments for Citadel, right? Now, I've got to say, that's a lot more than I'm getting right now, right? And obviously, these speaking engagements, they're just a way to give somebody the money, right? Nobody's worth $100,000 to talk for an hour, right? Nobody's worth that, right? So I see these payments as just a way to kind of ease, just to kind of ease the way, to kind of grease the wheels. And so she had all this money from Citadel, and she's heading the investigation. And to head the investigation, she got something that I've never heard of before. I've never heard of an ethics waiver. It's a bit like a get out of jail free card, but that's just in Monopoly. I mean, did you know, it just doesn't sound right. An ethics waiver. It's like a principles pass or an integrity intermission or a standard suspension. It does not make sense. So I'm not saying that Janet Yellen is bent, but Citadel have paid her $810,000 for speaking engagements, and that's better than I get for this. And Citadel that paid her that took a big hit over this, right? And I don't see how that could not influence her decision. So I'm not saying she's getting paid off to make a certain decision, but she's met the Citadel people. She's probably had lunch with some of them. She's most likely got their contacts list on her phone. She probably gets Christmas cards from them. Let's put it like this. If you've got a close male friend, had an argument with his wife, and you're male, you're going to tend to believe his side of the story because he's in your inner circle, right? Even if his story is, she walked into a door twice, that's how she got two black eyes. It's just natural to believe people for a while. And I don't know how you can put that on hold. It's just part of our decision-making process, right? You protect your own. And of all the 300 million people in America, she's the most suitable person to lead the investigation. There's nobody else. No find a neutral person option. They created a term called ethics waiver. So I'm not saying there's a conspiracy. And I'm not saying there has to be something as overt as a fix being in for this situation, calls in the night, judges being paid off, offshore bank accounts being involved. I don't think that has to happen. I really don't. It could just be little nudges like Yellen getting an ethics waiver and the presumption she's human and naturally be more sympathetic to one side, right? She's human just like the rest of us. We are all a little bit more sympathetic to our side. So you get these little nudges to help sway the outcome one way, right? Which is another layer of the onion with this GME fiasco, which is playing out as we watch it. And primarily, I think the way this play out is the peasants need to be taught that they shouldn't be turning the tables against those that benefit from the current trading rules the most. So I think they'll put a few retail traders in jail, adjust the rules, and everything will stay the same. That's my theory. I'm not a conspiracy nut. But back to those $1,000 orders. And I'm going to ask you a question now. I want an immediate answer. Right, actually, is everybody awake? Can I get a yes if people are awake? There you go. Okay, so I'm going to want an immediate answer. It's not a right or wrong thing. If your immediate answer is dunno, it's fine. Just give the first thing into your head. Right, so you're on GameStop. You see this. You see people asking you to put your limit orders at $1,000. You see a lot of other people putting their limit orders at $1,000. Where do you put your limit orders? Give me the price. Exactly. Put your limit orders at $999. Yeah, exactly. That's game theory, right? So basically, that's exactly what I'd say. I'd put my limit orders at 1,000 because I wouldn't want to be the asshole on Reddit that everybody rails on for putting my orders in front of everybody else. But I don't really get that, right? So the person that requested that, I imagine the first person that requested that had a plan to do the same. I don't think the first person requested that was going to put his own limit orders at 1,000. I think 999.99 or somewhere like that. And I'd also suspect that if we ever got close to that, and I don't think we will, you'd start to see limits at 999.99 and then 98 and then 97. And people would just lower them and keep lowering them to be the lowest high bid, right? And it doesn't make you a bad person because this is absolutely normal. This is how people do things. they're taking care of number one. It's just human nature. And game theory is all about understanding that aspect of human nature. So the idea that all these people put their limits at 1,000, I can get that they are right now. But if price ever got near it, they would all stop moving. Absolutely. I just can't believe that people would be so naive, one guy asks a bunch of people on the internet to do something and everybody on the internet does like good little sheep at the same time that they're patting themselves on the back for being mavericks by stiffing the hedge funds, right? You know what I mean? It's just absolutely wild. I think it's hilarious. So game theory is about understanding that aspect of human behavior, but it's an aspect of trading techniques is rarely discussed, but because the fact is, if a specific method of analyzing the market is valid, it doesn't necessarily mean that the people using it will play it the way you expect, right? So if something sets a price level, what do you think? Everybody's just going to put an order in at that price level? I mean, they might at first, but they might say, well, everybody knows about this. How do I kind of get in ahead of them? It's one of the aspects of trading we don't talk about much is like, if that does work, are people going to try and game it a little bit, try and get an advantage or sneak in or something like that? If something's widely adopted, I would expect it to morph over time as people try and beat the crowd. So in trading terms, you would expect that impact to be more influential on a specific technique if it was in play with markets with a lot less volume, a lot less relationships than the S&P 500. And if it was in play in quieter times, right? On the other hand, any valid technique needs enough players doing a certain thing for it to impact price, right? Which is why the concept of secret levels is hilarious, right? Because if you're looking for a reaction at a certain mathematically or visually derived price point, you need people to know about that price point for there to be any sort of reaction, right? And I see people right now using floor trader pivot points, and there's no trading floor anymore, but they still use the floor trader pivot points. And stuff like that I find very odd that they still believe in those things. But to use those things, for those things to be effective, they need to be widely adopted. And then if they're widely adopted, how is it that people don't start running in front of them? And it's like, I'm almost saying nothing will work, but it's actually the contrary. I'm really talking about the rationale for something working, or why would traders react in a certain way after you enter in order for you to profit? And then why wouldn't that change when they find out you're like front running their behavior? Because some of the techniques that we see used out there require other people to have a change of heart, right? Some of the techniques we use need people to change their mind, right? And if that is going to happen consistently, they're going to change the way they change their mind over time because you'll keep taking advantage of them. Now, there are techniques that require people to carry on with what they're currently doing, right? They don't need a change of heart. And other techniques require people to do things when they've got no choice, like repositioning after news or getting knocked out of position, right? So there's kind of like three main causes that people look for in trading. But we need to understand what makes these decisions. Now, we can see other things happening in our industry that make no sense, but are explained by game theory, where players seem to participate in self-destructive behavior, even though it makes no sense, right? Because their decisions were so influenced by the other parties in that game, like the game of zero commissions, right? So Robinhood exists purely because of this act of selling order flow, and they were pretty smart and savvy to create a zero cost brokerage, but that just sold the order flow, right? So you come to Robinhood, trade for free, although we will sell your orders to Citadel, and you'll really barely feel what they do to you, right? And that was fine, and that was the status quo at Robinhood for a while. And then one of the major US brokerages did the same thing. I can't remember who it was. Was it E-Trade or TDA or somebody? One of the major US brokerages did it, and then 2 weeks later, everyone had done it. It was the fastest race to the bottom in history, I think. So, and when we talk about race to bottom, prices don't usually get to zero, but this was a true race to the bottom. So these brokers that did that, did they do it for the benefit of the trading? Nope. Were they happy about it? Nope. But they did it because everybody else influenced their decision, right? Now, they can make money from selling order flow. And also they're sitting on billions of dollars in cash balances that they can use to make money. And that's really why they all had to play, but they didn't have any choice. And you see the same thing. It's not going to happen the same way. But if you look at the futures brokerages, I think that's a tough game. So you all know what the difference between an IB and an FCM is. Okay, so yeah, the FCM is like, the FCM can clear your trades, and they have a really, it's a tough game being an FCM, man. I really feel for the guys with the FCM. So an FCM has a lot of responsibility. There's a lot of cost, a lot of regulation, and then the IBs are basically agents of the FCM. The IBs can't clear your trades. Now, the problem with being an FCM is if an IB does something that one of your IBs does something that gets a trader to lose money, you can be on the hook as the FCM, right? You might have to trade to pay the trader back his losses, and that's not because of anything you did; it's because of something an IB did, and I think that's pretty tough. Right? I think that is really, really tough, and the IBs themselves, you know, that's a tough game. It's a race to the bottom. Nobody cares about anything but commission. Right. So if you look at the futures brokerage industry, it's a tough game. And I think we're going to end up with one Amazon.com brokerage. And I don't think that's going to be good for us. Right. But it's going to happen. And the reason it will happen is because of game theory, because of the way they will all react. And maybe somebody will say, you know, we're not going to drop our price. We're not going to play this game. We are going to be premium. Right. And maybe that'll work, or maybe they'll go out of business. Right. But generally speaking, that is kind of the rarer move. So we've got something going on in our market today that's going to make it less competitive in terms of fees because of the way game theory works. Now, we saw something similar with HFTs, right? So HFTs, I think it's the fastest we've ever seen a best new industry followed by a race to the bottom, right? So if you don't know, there are far fewer HFTs now than there were 10 years ago. Right. And if you think about it, things like arbitrage, think about arbitrage, which is the art of trading a price divergence across two instruments. Right. But how big a divergence? Right. So if you get in at a smaller price divergence, you'll be in before the competition, but your returns will go down. Right. You'll make less per trade. Now, if you use technology to get in at the same divergence, but faster, then your costs go up, right? And that is, you know, kind of, again, eroding the amount of money you make, right? So that's what we saw in the HFT space, right? Now, of course, if you're a big fish with all these little minnow HFT firms going into the market, you could do something like trade at a loss or trade at break even just to push the competition into bankruptcy. And that might or might not be legal, but it's definitely borderline. You certainly want to run it by your lawyers, because then you hit anti-competition laws. And that's really why antitrust and anti-competition laws exist, because it's not uncommon for people to weigh up the cost of getting away with something against the rewards of winning. And so in our industry, you know, what we see in our industry is the regulators have got far less money, right, than the people trading. Right. So the regulators tend to be one step behind. The money they've got for enforcement is ridiculously low relative to the money made in the industry and the lobbyist money, that kind of thing. You know, let alone the money made from breaking the rules. So our game has rules, but anyone that follows the financial industry, you know that those rules seem to be quite flexible the more money you have, right? You know, the more money you got, the more flexible the rules are for you, right? And one example of that, and I'm not going to say that I'm not going to say who was right and who was wrong, but I'm just using this as an example of the kind of thing that can happen. But I'm not saying that it did happen, right? Because I can't. So Eurex, if you remember, maybe you remember in 2000s or late 90s, 1990s, they set up a futures exchange in the US to directly compete with the CME. Now, I don't know about you, but if you're going to pick a battle, I don't think the CME is a good person to have a battle with, right? And they failed, and they accused the CME of two things. First of all, of lowering their prices. Now, you'd think that lowering your prices would be a good thing, but it is an anti-competitive thing. If you lower your prices to the point you stifle all the competition. Right, so they're saying, you know, CME lowered their prices to the point it hurt both companies, but it hurt Eurex more and it stopped from taking off, right? You might think that would be okay, but it's an antitrust issue. Second, this this isn't so great in terms of being right. They're saying that the Eurex paid people off to stop getting approved, the approvals, and to stop CME getting off the ground. Now, CME were cleared, so we're not saying CME did it, but it's just an example of the kind of thing that people do in our industry to win. People don't want to follow the rules. I mean, game theory is about following the rules, but people don't want to do this. So while this doesn't directly affect your trading strategy, it does help you to understand that winning is really important to people. And if you're going to go against a bunch of hedge funds, you've got to be ready to, you might get a reaction from that, like you get sent away to jail, that you weren't expecting. You might expect them to play fair. So game theory is certainly worth looking at, but also you can't discount the fact that game theory relies on people following the same rules, and that doesn't happen in our industry, right? If you think the hedge funds are going to be good sports about losing billions of dollars on GME, I don't think that's very likely. I don't think they're going to be good sports about that at all. So when I look at GME, that was a risky trade, right? Intentionally buying something to hike the price of an instrument without any idea of whether somebody will there to buy off you when you sell to close. That's stupid, right? Who's going to be on the other side buying off your $1,000 limit orders, right? If you're silly enough to not front run the $1,000, I don't understand why somebody would be on the other side of that trade. And also that trade relies on hedge funds losing a lot of money. And their customers include very rich and powerful people. And your expectation is that they will just take that on the chin, like good sports, without defending themselves or bending the rules a bit to make sure you don't do it again. And what it is, and this is a lot of traders do this, the people getting into that trade only saw the upside, right? And it's so common. And I don't think there were that many people in that trade that were there to stick it to the man, right? I don't think that's why most people got in. I think most of them just thought, wow, if everybody else buys this to stick it to the man, I can make a big profit, right? So I think everybody did that. I don't think anybody just said, right, I want to get these guys. I'm going to do this, and just for the hell of it, just to get these guys and teach them a lesson. I don't think people did that. I think that's what they thought everybody else was doing, and they were gaming it, right? And it's just this whole thing fascinates me because to me it was just such a silly thing to do, right? Even though people made money, it's a really silly thing to do. I certainly wouldn't get involved in round two. I think round one, you got them. Okay. I think round two, I think they're going to get you, right? I think they'll gang up and get you. So game theory is a good start, but you need to adjust game theory in terms of that whole following the rules aspect. And there's enough examples in our industry of people not following the rules to get a good level of confidence in that. So that GME trade, it was an easy trade. And while there might be other similar trades before new rules close that opportunity for retailers, I think you might find next time the hedge funds do the same and they gang up to teach the retail traders a lesson. So this kind of thing, it's not a good reflection of how to attain long-term success with the markets, which is why a lot of GME traders that took profits are probably going to give them back and more, trying to repeat that experience of winning, right? And we do, even we, as smart as we think we are, we do tend to look at the upside. And the more upside there is, the more we want to believe it, right? So, like I said, it's fascinating, right? I can't guarantee it'll help you trading, but if you're a kind of person that's got a rosy outlook on life and that you think people are nice and generally honest, you should watch this stuff, right? Because people don't necessarily have to be a-holes to act in a way that makes them look like a-holes in your opinion, right? So game theory kind of helps you understand that. So you might not end up cynical, but you might believe things a bit less and you might look for more proof. A lot of things like the algos are taking it to the moon because there's a reason people are repeating this, and it's not because it's true, right? Now, I'm pretty cynical myself, and I have to admit that's always helped me, but I was cynical before trading. And I think it helps to understand the difference between believing something and wanting to believe something. And wanting to believe something is the biggest cause of failure and the biggest cause of spending money on crap, right? And part of it is just understanding the other side, putting yourself in the other person's shoes, even if it's a person that's selling you something, right? Because in that relationship, money leaves your account and goes into theirs, right? So when somebody's telling you you know, something, and they're also going to make money from you, you need to look at it in a certain way, right? If somebody's bearing gifts that appear too good to be true, then they probably are, like the GameStop trades in $1,000 orders, which they place because of their perception that would mean a payoff at $1,000 a share. And that's complete suspension of common sense, right? But it occurs in the face of big numbers. So if you're looking for a trading technique and you hear one guy say, you know, you're going to be 90% profitable and you're going to turn $5,000 to $500,000 in a week, right? There's a bit of you that wants to believe that, right? And he knows you want to believe it, right? And that's why he's giving you those numbers, right? And it's like I say, it's fascinating and it's worth it just to kind of become more of a cynic, right? Now, what we're going to do is we're going to talk about some other beliefs, and I'm going to just quickly go through some of the currently popular trading methods. And yeah, I mean, somebody's talking about the market being unfair. I don't think it's unfair. I just think it's not what you think it is, right? I just think it's something a little bit different. The way people approach the markets is very simplistic, and I think it's just a bit more layered. What I'm going to do now is look at some of the popular trading methods, and I want to question them, right? And that means I might question the ones you use, right? And that's not intended to upset. It's not intended to stroke my ego. I am not always right. You can prove me wrong if you want. I just don't get a whole bunch of stuff that people use right now. And that includes stuff I've used in the past, right? So I'll openly admit I've used stuff in the past that I look at now and saying, why would I believe that, you know? So if you prove me wrong about this with counter arguments, which I encourage, I'm fine, right? But if you aren't doing so well using something and nobody here can explain why it should play out in live markets, maybe it's going to help shift your focus and make things a little less complicated, get out of a rut. Because keeping trading simple does mean getting rid of some stuff, right? That's not helping or not required. And the key to it, and really the reason you need to keep these things simple, is that you're making decisions, right? And any decision you make that's got 1,000 data points to it, it's really hard to make the decision consistently. So the fewer data points you use, the more consistent your decisions will be. And then once you're making decisions consistently, that's when you improve. But most of all, this is the bit my cynical personality has been looking forward to, Riggs. There's this thing that I think Teddy Roosevelt said, you know, nobody remembers the critics, or it's not the critics that count. And I do agree with that, because I can't remember the name of a single critic, but I know lots of writers, actors, movie makers, singers and that. But I think Teddy misunderstood critics. I think he missed the fact that critics gain pleasure from the act of criticizing, and they don't gain pleasure from being remembered for it. In fact, as a critic, being famous and being recognized in the street, I mean, it must be a bit stifling, right? Because a critic, you're really burning into people, and being recognized for that is not a benefit, right? So I'm going to criticize some stuff, but it doesn't mean I'm a genius, right? And I'm going to say, first of all, what are the things you need to be wary of? Nobody wants to upset their guru, right? And that's a big thing in the market. So I know if you're talking to somebody about trading, you don't want to upset that person. You don't want to question that person. I'm very wary about things that say all markets, all timeframes, all conditions. They're just, to me, that's just BS. There is no technique that does that. I'm also very wary of buzzwords. I hate it when people use buzzwords. You know, it's just a way to make yourself feel clever. And my experience with buzzwords is like we've had things that are exactly the same, but are reinvented with a different set of buzzwords, right? You know, different decade, it's the next big thing because it's got a different name for it. And I also find that things get reinvented to sell consultancies, certifications, standards, and methodology. And over time, you see that like things getting reinvented just so they can sell you some consultancy to do what you're already doing. It's like you get a cool merit badge, but you have to kind of wonder, like, did I need that methodology? I also think that anything that is based on a given, when the given remains unexplained, is a problem. So if your technique relies on a certain thing, but that certain thing hasn't been proved, how does the method make sense? And that's where this thing about things that are explained, but the explanation isn't an explanation, right? So things like when somebody says the market is an auction. Okay, I get that. The market is an auction, da, da, da. But when I hear that, I think, well, what do you mean? Because I've been to car auctions and house auctions, and it doesn't look like that. It's not people selling and buying at the same time. It's you buy the house. There's a seller and an eventual buyer. So it's like a one-to-many relationship. So when somebody says to me, the market's an auction, the first thing I would say is, could you explain that? And people don't like to do that with their guru for two reasons. You don't look stupid by asking a question, and it might make you look like you don't believe them. And those people have sold themselves as the key to your success, and you don't want them to reject you. So sometimes you get an explanation that doesn't explain anything. Everybody pretends to understand. Everybody pretends to understand, but nobody understands. Now, there are plenty of people who don't mind being questioned. A great example, I think, is Alex Hayward at Axia. And I know Alex really well, right? So we've met in Thailand, we've met in England. We quite often have a chat on a Sunday. So he wakes up on a Sunday and we get on a call and we just shoot the shit, right? We do talk a little bit about works. And sometimes we talk about trading. Sometimes we talk about education. Sometimes we talk about something that's not trading. And we disagree on a number of things. And he's a great example of somebody that is a joy to disagree with because his ego doesn't come into it. And you just have a dialogue to understand the other side. But there's not many people like that. People are kind of dug in, right? People are dug in on their side. And you don't really benefit, or the world doesn't benefit from argument anymore, from debate, because everybody thinks it's about winning, and it's not about winning. It's not about ego. It's about understanding both sides. I know people in the industry that will turn on you if you question anything they say. And that means they probably are insecure about it. So if you don't get something, just keep asking until you do. And if that's a problem, you're in the wrong place, right? Now, the trading that you do, you're going to be trading one or two things, right? You're going to be looking for one of these things to happen by applying a technique. So almost all of the retail trading techniques that we see out there, they're focused on the market doing a U-turn, okay? Which means the market participants need to stop what they're doing now and do something else for you to make money, right? And I think that's because there's like a vicious cycle at play. So a lot of people come into trading for easy money, right? And they look at their capital and their goals, and they think they need to take massive bites out of the market by buying lows and selling highs. And they will want to believe people that are selling something that fits that dream. And the people that aren't selling that go out of business, right? So the people selling that dream in the education space are going to survive because that's what people believe it is. Now, on the other hand, you can trade what is happening right now, not expecting the market to do a U-turn. It is far less sexy and far more reliable. And people take a while to figure that out. So before you even look at technique, you have to ask yourself how much heavy lifting is required by the other players in the market for it to work. And remember, if you trade in the S&P, that heavy lifting isn't just moving the S&P futures. It's moving everything, right? And if you need those players to do too much for your trade to work, it's probably not going to work out. Now, I don't expect you to agree with this because it's a major change of heart for many. And that doesn't happen in an instant. But I'm going to keep saying it because I do really believe it, right? Does anybody like to disagree on that? I'm fine if you do. Somebody asked if I believe in one-time framing or spike or gap rules. We'll see about the one-time framing. Gap rules, not so much. I don't understand why. And we'll look at that in a second. Now, so what I'd like to do is if we can agree on some things, it will help. So there are big players that trade long-term, right? We know that. Mutual funds, Fidelity, BlackRock, people like that, they do exist. And they do seem to be behind major moves. Would people agree that there are big players that come in and readjust? They hedge their positions. The people that have pension funds, that run your pension. Do you believe those people exist, right? So also, I believe myself that they tend not to react to smaller moves, right? So if you see Fidelity coming in because there's an announcement that interest rates are going to go up, and so Fidelity do a hedge, or Fidelity decide to lighten up a little bit, they're going to do that, and it's going to take time to do it because it'll be a big position. Are they going to get out because a moving average crosses over? Or really anything that happens that day? Are they going to get out in that day because we hit one of your levels? Yeah, I agree. No. So if you look at these guys, they're trading long-term positions. One of the things about auction market theory, it calls them OTF, or the time frame players. And I agree with that. And one reason I agree with it is because they get in one day and they don't get out on the same day. It's a long-term position. They're not looking at price microscopically like day traders. So we can expect their trading to be one-sided overall on any given day, unlike day traders that tend to be in and out on the same day. And part of the reason we're in and out the same day is the margin rules. It's more expensive to hold overnight. So are you all comfortable with VWAP? Do you know what VWAP is? Okay, so VWAP's like an average. It is an indicator, but it's basically a benchmark that is used to assess the quality of execution. So if somebody's executing a large position, you want them to be, achieving VWAP or better. That would be good if they can do that. Now, I don't know if that's still used by execution firms. I really don't. But it does tell us that the placing of large positions or unwinding large positions isn't done at one price, right? It's actually compared to a rolling price, which is what VWAP is. So it's a good execution is rated against getting good prices at the time, and prices move, right? Do you believe that if Fidelity want to get into Tesla, they're not going to get in at one price? Now, VWAP isn't an area. VWAP is a price, but it's the price that moves through the day, right? Now, do we believe that if there's a major repositioning going on in a day, do you believe that the firms can all get in at one price, or do you believe that they'll get in over a number of prices? Let's say you have to buy 100 million Amazon shares. Yeah, it's going to be over a number of prices, right? And what will impact that is how urgently you need to get out, right? So sometimes they really need to get out very urgently and they're going to move price more. Sometimes they're getting in over time. And then there's extreme cases where they're liquidated and they're forced out of their positions. Like I think some of the shorts on GME were forced out of their positions. So, in an extreme case, you get put out of the position by your broker, okay? So we have these long-term players and we know they exist. And a lot of our techniques are based on some suppositions about what they do. And one of the suppositions about what they do is that they do this at one price. So I think we just have to, if you don't believe it, you can look it up. And I will give you this link. I'll put it in the blog post for the recording. But this link here, it's from a law website, but it actually looks at execution and VWAP. And I'm putting that out there because if you read that, you'll know I didn't write it and it's not from me, right? So the idea that there is demand at a single price, I don't understand it, because if you've got to buy 100 million shares, you're not going to just say, well, I'm going to buy 100 million shares. I'm going to buy Tesla or a share at $30 because I think it's going to 70. But if I can't get $30, I'm not getting in. If that was the case, then mutual funds would be very light on shares. And so people get in over prices over time. As long as they get a good price, overall, they're going to be happy. And so we have those other time frame players. And then we might have something in the middle, but there is not much said about speculators that aren't big funds but aren't intraday. Now, I do believe they exist, but I don't know anybody that's ever worked for a firm that's holding positions for multiple days but aren't big funds. And there's not much said about that in the market. And that's one thing I'd really like to understand is like, what is the size of that market? And you can get on without knowing this, but like if you did know this, you could probably make some suppositions about holding times that are different from the ones we have now. Anyway, we're going to look at auction market theory, and I'm going to tell you auction market theory as I understand it. And I could be wrong because I don't really study it. I did do a few Jim Dalton things at the start. I do love Jim Dalton, partly because he's smart, partly because he looks like the best granddad ever, right? He's a nice guy. And when I look at these rules, I'm not going to go through them. You can read them. It feels a little bit dated. So when we look at things like locals, the pit traders, the market makers, and middlemen fill in the orders of other time frame players, which are the big boys, right? They operate with them one day. When I look at that, I think, well, that's a bit dated, isn't it? Because there is no pit, right? But I do agree with the idea that there is merit to saying there's daytime frame players, because margin rules do push us towards closing before the end of the day, right? So short-term traders end up flat. They can trade more size if they do. But I've been to auctions and I've watched the markets, and I can't relate what I see in an auction to what goes in the market. So calling the market an auction to me isn't helpful, because if I say the market is an auction, I expect it to fit a commonly known concept of auctions in the real world. If it doesn't, I don't find it helpful. Now, of course, if you look at treasury auctions, it does fit that model, but that's not what people think about when they, hear the word auction. So when I hear somebody say the markets are auctioning up, I just roll my eyes because I think it's a crass attempt to sound clever. which also has people thinking that they missed something. Okay, so it's an auction, it's great, but nobody's ever really explained to me how it's an auction or how it's like another auction, and or why that's useful. And then we got things like if we look at one of the other things in there, so market as an auction, I don't get how that's helpful. I don't think there's an explanation for it. The concept of the IB, which is the first 30 minutes, that baffles me, right? So the IB is a period where locals attempt to find a range where two-sided trading can occur. Okay, now I did go to the pits, and they were all trying to make money. None of them were trying to find a range. So why are the locals purposely trying to find a range? And how can they do so in the face of something like news? And why is it done in the first 31 minutes and not 27 or 32? And I look at that and think, well, that's strange. Why 30 minutes? Why locals, why is that so important? Now, I've seen stats, and one of the statistics that I remember the most, that stands out the most, and I thought it was funny at the time, and somebody told me this and they were really proud, is they say that when the price is above the OTF, above the IB at a certain time, there's an 80% opportunity it'll close above the open. But it's already above the open, right? I don't really care if it's going to close above the open. I don't want to know if it's going to close above where we are now, right? And I've never seen that stat. I've never seen somebody say, if we're above the IB at this point, we're so many percent likely to close above where we are now. And that's what you need to know to make money. But so that 80% stat, I've never really questioned it because I don't really want to get into the tussle with people. Again, I think, how is that useful, right? It sounds good, but you think, well, it doesn't mean it's going to close above where we are now. The idea is that moves outside the IB are caused by OTF players, right? So other time frame and like institutions, non-day traders. And again, they say that if the market moves outside of that initial balance, that first 30 minutes, that's other time frame players. I find that odd, right? If the IB is a range, right, and it's mostly day traders, it's still going to break because it's a range. One side gets stopped out, right? That doesn't mean an OTF has stepped in. And if it continues, it still doesn't mean it's OTF. People trade the path of least resistance, right? So again, I don't get that, right? So there's like this really neat separation used to explain lots and lots of things. They're actually a bit more messy and visceral and tradable. And, I just don't think it's helpful to try and pigeonhole things so much because that's the mindset you get into. And the markets are a bit messy. And I think it's fine that they're messy, but you expect them to be ordered. And I think that's problematic. Now, the idea also, they say when a market's in a range, buyers and sellers agree on price and we're at value, okay? Also, I don't get that, right? If there are people initiating new long positions at $100 and there are other people initiating new short positions at $100, it means they disagree on price, right? One person thinks it's going up and the other person thinks it's going down. And so I don't see how that's price agreement. I look at a range like that and I think either nobody knows or they disagree, but it's not agreement, and remember, none of us are buyers and sellers. We're all both. We just play whichever side of the market we think will make money. So I'm not trashing auction market theory here, but, I look at this and I think, well, how, why, who? The 7-day types, I don't agree with because the day can start doing one thing and then do something else as an event, planned or unplanned, hits the market, right? So I prefer to think of it as the market having different modes or states that it can shift between any time, right? Usually prompted by an external event. And the other downside of having 7-day types is you're going to get into this, what would Jim Dalton call this factor? So like if somebody else defines day types for you, every time you like try and label the day type, you're going to say, what would Jim do? Right? And it's the same for the open types, so 5 open types. Using someone else's definition of specific market action is always going to make you end up thinking, what would they do? Right? Would they call it A or B? So the way I see it, if you you should have market states, but you're better off just naming the types of action you can differentiate yourself. Give them a name, maybe fast and slow to start with, just 2, right? And then just get a bit more complicated over time as you discern more nuances. Now, it's scary, maybe, but right now, you can all see slow and fast, right? So for most, you could have those initial states and be able to recognize slow and fast. And start with that. I think starting with that is a much better place than trying to recognize somebody else's states and never knowing if you got it right or wrong. Right? I just think, because when I looked at market auction theory, that's what I did. Is that an open driver? Is it this? And it was just like, And then I thought, screw this. I don't want to keep trying to guess what somebody else would guess. Now, the other one that people aren't going to like, because I know a lot of people lose this, an unfinished auction, unfinished business, poor high, poor low, that needs to be repaired. I don't get that. What would you do to repair it? Do you call the plumber? I mean, that's pretty far out there to me. So the implication is that when we create a certain pattern in the TPO chart or the footprint chart, and then move away from it, that certain traders are going to feel compelled to trade back in that direction to properly complete the pattern. There's a name for that, right? It's OCD, obsessive compulsive disorder, right? That is not a good thing, right? Who is it that feels this compulsion? Do you sit there, right, and think, oh man, look at that high. It's really not right. It needs repairing. Oh man, that's like an itch. I got to buy until it hits that point, thinking, it's fixed now. Who does that, man? Come on. It's okay. So I look at that and I think, man, bad structure. It just went up and it came down. That's what happened. It doesn't need to go back and repair anything. And I don't really know what it means to repair. So I don't like that. But I tell you what, I love TPO charts, partly because they're quirky and odd, right? And we all love quirky and odd. We're humans, we all love quirky and odd. But I also think they pack a lot of information into quite a small space. And I think it's pretty cool. So overall, I don't think AMT is not terrible. I like the market profiles. But it comes across, I think what they needed to do, they felt they needed to create like a unified theory that explains everything. While at the same time, it doesn't tell you to watch the news, right? It doesn't tell you to get a Bloomberg terminal that all the prop traders have got. It doesn't say look out for presidential tweets. And it seems to have a level of complexity that would impact your consistency, right? I mean, if you've ever seen somebody live talking about volume profile, it's always it could do this or it could do that. And so you don't need that, man. If that's the best market profile can do, say it could do this, could do that, I can do that already. It only goes up and down, right? So I look at it and I think, well, that's a bit complicated, but it's been friendly so far. Surely you must not like what I'm about to say, because I can't wrap my head around this whatsoever. At one point I did buy it, right? But the more I thought about it, I thought, I don't get it. So I have to say this is nonsense. It baffles me why anybody believes it. Why it's very widely used and accepted. Long-term composite volume profiles. The art of taking a year or more worth of data, creating a volume profile across it, and expecting it to tell you something about future price points of significance, right? I don't get that, man. I don't get it. So even though I'm saying that, I can feel myself sucking the energy at this beating with my negativity. So you've got like LVNs or low volume nodes, which are these like little areas here. And where not much traded across the entire year. And then we get these fatter areas where a relatively large amount traded. And the explanation for those price points being important in the future and therefore having predictive value is usually the market has memory. That we can see areas where price was rejected before and price was accepted, and that the market will reject those prices again because it has memory. Now, the market has no arms or legs or body, it has no head, it has no brain, and it doesn't have a memory. So that means as a trader, it's you that has that memory. It's the traders, it's us. You have that memory, but memory of what, right? Because this is a composite profile, a summary. So the actual LVN might be a different price from the one you traded yourself, right? Because it's a loss across a lot of action. But even if you ignore that kind of averaging effect, the composite price might not be the price you traded. I can't remember what I did months ago. I don't necessarily trade a price that I traded 30 minutes ago. So if I bought at a level 30 minutes ago, I wouldn't necessarily trade it again. So why would I do so 6 months later? I have trouble actually remembering what I had for breakfast last Saturday. But if I and you guys are the market, it means my fellow traders are placing trades purely based on the fact we traded there before. So that means also you are subconsciously putting on trades because, I traded it before, and I'm going to click. It's completely outside of your analysis. So I look at that and I think, man, who is it that's doing that? Is it a particular firm? Is it a particular set of trade? I don't know who's doing that. And I don't understand. This isn't Garrett. And I just don't get it, man. There are plenty of reasons to enter a trade. And I believe that I generally know that I'm taking a trade. And I can't ever recall thinking, I bought here on October 23rd, 2020. I feel a compulsion to buy here again. And if I did think that, I'd say, don't be stupid. So to me, that explanation is nonsense. I've never heard another explanation of why it will work, and I don't get it. If somebody can explain it to me, I'll get it. But if I don't get it, I can't use it. And if we know what we do about what a firm considers a good price, which is a moving target, there's no reason to think institutions will have orders there anyway, right? So VWAP that has been used, I don't know if it still is a moving target. So if Fidelity think that Tesla is a good buy and it's going up, they're not going to just put in a massive bid at a price and wait to get hit. No, they're going to be happy to get in over a range of prices up to a certain price that makes it too risky. Or put it another way, if a fund thinks a $30 stock will go to 70, they're not going to get millions of them at $30, right? But they're also not going to refuse that opportunity because it goes to 30.02, right? So they might be happy to buy up to $50, and I think, anything else is a bit too risky. So the idea that big funds have got all these standing orders at certain prices just because somebody bought there before doesn't make a lot of sense to me, because they're going to get into that position, and there's no reason once they've got that position on that they would buy at a certain price that they got into before. I'm open to suggestions, right? I don't see it, right? Now, again, there are levels that get hit a lot, and that's fine. There are levels that get hit a lot, right? And that's fine. I'm not saying there aren't levels that get hit a lot, and there's stuff that goes on in the S that is clearly stuff that repeats. But I'm just saying, I don't understand who it is at that price that's sitting there. I don't know who it is. So please don't. I'm not trying to beat you up or disagree. I don't know who it is. Right now, support and resistance, supply and demand zones. Right now, everybody believes that support and resistance exists. Right, and almost all discussions on support and resistance revolve around how to define it. I don't ever see a discussion on whether it actually exists. Right, so it's a bit like saying, right, we're going to define ways to locate the Loch Ness Monster, okay, because it presumes the Loch Ness Monster exists. So the issue I have with this, right, it doesn't matter what somebody else trains. I'm just giving you my take. I am not right all the time. I am fine, right? So the issue I have with it, right, support and resistance plays directly into the mindset of buy the bottom and sell the top, right? Absolutely. So you end up looking to buy markets that are moving down, and you end up selling markets that are moving up, which is trading against momentum. And then there's no explanation generally of who is waiting down there when you look at this supply and demand model, right? So if you agree that funds are going to buy as price moves up, as opposed to having limits at a set price, it doesn't make sense that they're the people who are creating that demand zone, right? So whose demand is it? Is it just a self-fulfilling prophecy because lots of people are looking at it? It might be, and that just might be a good reason to get in, but it doesn't necessarily mean there is actual demand there. So now, what I will say is that I think the concept of a price being defended is something that can make sense in some cases. So there's something called a barrier option that pays out if a certain price is reached. And one of the first professionals I met retired at 35 after running a team that wrote barrier options, amongst other things, for Royal Bank of Scotland in Singapore. And the size of those contracts were like eye-watering. And I can see how some effort could be made to either breach that level or stop it being breached. So I can believe that people will hold, but I don't believe that's the norm, right? And I don't believe that there's just like all these orders sitting there from people like Fidelity, and they go, oh God, that $30 stock went to $30.05 and we didn't get in. I believe they follow it and get in and up to a point. So I don't understand why there's all those resting orders there, right? I do think that people are looking at it, and maybe that's all there is to it, right? But surely can't be the norm that you just draw a line in a chart and hold high and just presume there's some sort of barrier down there. So what I think is like, how do you boil it down to? Who is it that's there and why? And I've never heard the explanation. So I don't want to rely on it too much. I don't want to put in orders there. Now, I'm also going to say this. You cannot ignore the way S&P 500 honors specific price points, right? I remember the first time I looked at the bund after looking at the S&P 500 for ages. I'm like, oh God, it's like just moving in the middle of nowhere. Now, it's not so much now with the volatility, but things like the overnight high and low, yesterday's high and low, open price, do seem to regularly have reactions, right? You can't get away from the fact that those prices are significant. And you also can't get away from the sheer weight of retail traders trading it intraday, right? So if you just looked at the ES, go and look at the bund, and you just think, God, it's just cluttered. You don't get it, right? So I do think that partly because of the massive amount of retail trading in the ES, that those levels are significant. There are levels of significance, but I don't think it's reliable enough to just trade the levels. Now, I do think that trading when the market has turned at a level it makes more sense, riding the momentum if something holds. But overall, I struggle to back this horse as well. And I meet a lot of traders that have been trying to make this work for years, to the point I just can't buy it anymore. Everybody's trying to trade with support and resistance, and nobody's making it work, right? So I'd love to hear why I'm wrong, man. I do agree that very traders like to get in where the market lets them. Well, you're saying, let me just read that again. So would you agree that very large traders tend to get in and out where the market lets them? I don't know. Well, like if they have to do a major reposition, they have to get in at certain prices. And it's not, if you have to go longer position, you might actually do selling as well. You're going to sell and you're going to buy because you're trying to muddy the waters, right? But I don't think that means a price. I don't think it's like any easier to get in at one price than another. Yeah, I don't know. I mean, I don't know what you mean by where the market lets them. I mean, you're gonna take the chunks out of many, many different prices, and the size of those chunks will depend on the liquidity, right? So I don't think you'll refuse to trade a price as a fund because there's not that much liquidity. You'll just take a bite out of it to fill your position. But I could be wrong, right? And I agree. Overnight high and low, they are obviously significant. Right, you can't deny it. You can't ignore what's in front of your face. But I think the problem with support and resistance is it's not in front of your face. It's an optical illusion a lot of the time. And I don't think, you'd think by now there'd have been a study on how often it works. Just one method of setting support resistance. How reliable is it? It's a technical thing, right? You could program a computer to do it. And I've never seen the study. And I would think by now we'd get that, right? But I don't necessarily think it's... institutional volume playing at levels, because I don't believe those levels hold at any significant amount. I don't think it's any more than 50-50. I don't think it's even 50%, right? Because if you look back at a chart, you can see support and resistance, but every trend has pullbacks, and every pullback is at, when we get the continuation of a pullback, at some point, you are at the last high price before you go through it. And that is resistance failing, right? But you look back at the chart and you see where it held. But every trend, if you get 5 pullbacks, that is 5 times that resistance failed, right? So I'm not saying you can't use it. I'm just saying I can't use it, right? I'm not trying to. I'm trying to say I'm the world's biggest expert in this stuff, but I don't get it. Now, where's all the simple I said, right? We didn't really keep it simple yet, because it just feels like I gave you more work, right? And I think it's natural for the trader at home to scale up the complexity over time, right? So if you think about it, you probably started off with a couple of moving averages, and then you saw that didn't work, and you thought, God, I was probably a bit naive there. And so things get more and more complicated. And it's not stupid to think that you're not performing well because you lack knowledge. So you might say, I'm not doing well, I lack knowledge, let's learn more. And it gets to the point where people have got this encyclopedic knowledge of trading that far surpasses any proprietary trader I know, right? Most people I know that have been doing this a while have got loads and loads of knowledge of stuff that really doesn't work that well, right? And but they always think the knowledge is the answer. So, they get more and more knowledge of trading techniques, and they make things more and more complex. And it's not necessarily useful knowledge, but certainly to the point, there are so many data points that they can use. They don't really know which ones to use, and they end up with too many to make consistent decisions. And when you get to the point where you've got too much on your screens to make consistent decisions, you are done. You're at an impasse. You will not move forward, right? So you have to take some things away. And today, I was just really giving you some suggestions of things you might want to take away, or a view to use to take some things away, right? And here's the way I'd see it, all right? Last slide. I didn't think we'd go this long. You've only got so much time, right, to do this, right? You have not got an infinite amount of time, right? And time is worth so much more than money. So what you need to do, if you've been doing this 5-10 years, is say, look, man, I've got to find a way away from this, right? I've got to find a way out of this. I can't keep going through this cycle. I think the first thing you need to do is get rid of this, it's all in the charts stuff, right? Because it's not all in the charts, right? If you look at the markets don't constrain themselves to charts. There are things that move the market. There are things that are technical that move the market, and things that aren't, right? So a thing that's technical is like a range, the high and low of a range, and a range breaking. That is a technical move, right? And when it breaks, you've got a good opportunity because, if a range break is a really interesting trade, because if it works, it moves fast. And if it doesn't work, it falls back into the range, which is slow, right? So it works, it's fast. It doesn't work, it's slow. And that isn't all in the charts or all in the dome or whatever. But there's other stuff that goes on that moves the markets that isn't in the charts. And there's nothing that says it has to be all in the charts, right? It's a wonderful, complex world. And if you say it's all in the charts, you'll always not be aware of stuff that's happening. News is important. What's going on in the world is important. It's not that hard to use, to incorporate. What's harder is to try and make it work based on one specific subset of information and refusing to use anything else. That's the difficult thing. That's why people spend 15, 20 years. Now, the market does go through different states. And this is why sometimes you feel like the king, that you can do no wrong. There's days where everything you do is right and every trade you take is perfect. And then there are other days where you think you're the village idiot, right? Where everything you do is wrong. And that is simply a case of applying the wrong strategy in a specific market state. And you don't need to use somebody else's market states, right? You can just say, well, I can see this and I can see that. So, and then there's other times I can't really tell what it is. So the two things that you can tell, define those states, give them a name, and you say, well, I know those things, I can see those things, and then figure out which strategies to apply to those states. So it might just be a range and a pullback, right? But get self-dependent, get independent, and if you don't have market states as part of your strategy, you will fail because you will apply a strategy that doesn't work in a different state. I mean, take a pullback would be the worst place to trade in a range, but it's the best place to trade in a trend, for instance. So you've got to define states as they mean to you. If you want to use somebody else's, just make sure you're sure what they are, that you don't second guess yourself when you use them, and then apply strategies by state. And then look for the events that move the market. One of the events is news, right? You cannot deny that news moves the market, and everybody says, I don't trade the news. And it's like, well, the market moves on the news, and you can't stop the news occurring when you trade. So, this, I don't trade the news. It's like a very firm thing. It's too volatile. I don't trade the news. And it's like, you can't really ignore it. And if you do, then you're probably not going to make it. But other events like stop runs, enhancing risk and reward, they're also events, right? A technical event, a news event. There's nothing that says an event that moves the market has to be a specific type of thing. And then just try and get some of that stuff off your screen, right? So that not necessarily because it doesn't work even, just because if you've got 50 data points, you will find it very difficult to make a decision on those data points. And it is a problem because if you can't decide consistently, then you won't ever trade consistently because it'll always be a moving target, even if you're looking back at what you did today and what did I do well? Well, you did something completely different from what you've done any other day. And I think that's really difficult. But the market states, right? The market state, just find things you can see in the market state, like fast and slow, right? Just start with that. And once you get used to doing it, you'll just add more over time, right? And so I know it's easy to say, keep it simple, right? But if you've just gathered all this stuff over time, some of it has to go. And if you believe in all of it, just get rid of it for the sake of making a consistent decision, right? And then, forget all this stuff about trying to understand everything because you can't, right? So, that stuff doesn't really matter. Now, a few questions. It's easy to say less is more, but, you need to define how much less, right? And you need to kind of get consistent with it. Only reading the DOM is fine, right? But I don't see any reason if you've got some chart related stuff, I don't see a reason you have to get rid of it, right? Because, you don't want to keep reinventing yourself and starting again. So if you've been using charts and you found some use from them, keep them, right? You don't have to get rid of them. Maybe one day they'll go, but don't keep reinventing yourself. Now, I've got a couple of questions about market profile. Somebody says, do you believe in one time framing? Well, one time framing is the market going up every 30 minutes without putting in a new low. So yeah, I believe that happens. And that is a market that's going up. And I don't think there's anything wrong with that. Gap rules, I don't understand because I don't understand why the gap needs to close unless we get back to OCD. I don't understand why the gap has to close. Who is it? This guy, oh my God, there's a gap. I've got to close the gap. I've got to close the gap. It feels bad. I don't understand. I don't get it. Somebody says, have I read Sinek? I don't know Sinek. Who is Sinek? Yeah, and you have to tell me who Sinek is. 70% of TPO, the value area. Now, I don't know if I believe. Well, I believe the POC, the highest traded price, is the worst place to get in, because if you trade a lot in an area, you tend to go sluggish through it. How do I explain such little volume at certain prices? People didn't trade much there. People had no interest in buying at those prices or selling at those prices. That's how I explain it. I don't need to explain it. That's the thing. Then, to be honest, that's the thing. If I look at market auction theory, they could have stopped at a few things and had something really useful, but they needed to create a unified theory. And I think when you need to explain something, that's where you run into trouble, right? You have to, if you can't look at that, that map of how complex the markets are and say to yourself, I can't explain all that. Then if you think you can explain all that, well, good luck. But I think we can't. And I think that just leads us to a certain conclusion, which is if we can't, we shouldn't try, right? Simon Sinek, I'm going to write that down and I will have a read. I would love to hear rebuttals to my question. If you want to send emails or something, I can put them in the blog post about this. I'm fine with disagreements. Yeah, I mean, if you look at somebody saying there are some interesting facts about how large traders, successful traders do things. When I started, and I met that guy at Royal Bank of Scotland who was 35 and retired, and he'd been writing barrier options, I couldn't do that. I couldn't write $1 billion barrier option. I don't have $1 billion, right? So there are things that happen in the professional world that you can't do, right? It's fine, and I think that's fine. So it's the trading world. There's a lot of different techniques in use that wouldn't really apply at home because they just require such massive amounts of money. And I think that's fine because there's no reason they should all be available. But anyway, that comes to the end of the presentation. We didn't get into a lot of disagreement, but what I will do is if you guys disagree with anything or agree with anything today and you want to send me an email, what I will do is I will put those emails in the blog post. I might have a rebuttal, but if I do, I will give you a chance to have a rebuttal, and we'll put those in there so that people can hear a different side, right? Because they shouldn't just hear my side. It's all opinion, and it's all opinions. You know, something you use that might be useful because it's a lucky rabbit foot and it keeps you consistent. So my attitude towards all of this stuff might just be a good way to stop me using it and keep me consistent. So it could be a lucky rabbit's foot, right? I heard the inventor of market profile said it doesn't apply now. Well, there's a bit of a story there with Steidlmeier and Dalton. I mean, Steidlmeier invented it. Jim Dalton made all the money, and I know Steidlmeier invented this thing called volume strips. And so I'm not surprised that Steidlmeier said market profile doesn't work anymore, but I can't understand why it doesn't apply. Why did it apply before and what changed that it doesn't apply now? So it's one of those things that when somebody says that, I say, okay, why? I'm cynical, right? It's a cynical thing, but I don't understand why it would stop working. What happened, right? But I do know that Dalton made all the money and Steidlmeier invented these volume strips that he said, this is now the replacement for market profile. And I don't know if that was all about market profile not working anymore, rather than, damn, I invented something and Jim Dalton made all the money, you know? But you know what to say, it's not having the best product that counts, it's having the best marketing. And I think that's where Jim Dalton was really good. And, good luck to the fella. Right, have we done any more questions or any questions I missed? Yeah, well, I think the concept of, I agree, but like the stock market's still 24 hours, right? So it is that the pits don't exist now. But I'm not sure that's a reason it doesn't work, because really we still do the same thing. We still have day traders and larger, bigger players. But we'll see. We'll see. I don't know why it works in the first place. So anyway, I hope you enjoyed it. It's not really here's a technique, because I think we've done technique, but I just think there's other things that can help, and it'll try and bring something different. But we've got one more of these to do, and then we're going to do some. We're going to bring some people along. To help that. But I would love to just explain and maybe drop me a message so I can do it in the next session, but it's 2 hours. It's late o'clock here. It's nearly 1 o'clock and I'm done. And I enjoyed it, man. I love doing these sessions because I don't have to script them, and it's just really low pressure. I don't have to sell anything at the end. I don't have to script them. I really enjoy it. And anyway, so thank you all for coming. I really do appreciate you taking time out, and good luck with your training.